Warren Buffett, the Oracle of Omaha, is considered the greatest investor ever. A $1,000 investment in his company Berkshire Hathaway at the start would be worth over multiple times today. Buffett's success isn't a mystery. It's based on 7 key principles anyone can understand and apply. This video will explore these rules that have guided Buffett's investing for decades. Do watch till the end, as you won't want to miss out on any of these rules. Are you prepared to challenge your investment thinking and adopt a long-term perspective that may differ from popular opinion? Before we dive in, I want to remind you to hit that like button and subscribe if you haven't already. It really helps my channel grow, and I appreciate your support. Without further ado, let's explore the wisdom of Warren Buffett and see how it can transform your approach to investing and business. Rule number 1. Prioritize integrity above all else. We look for 3 things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first 2 will kill you. Buffett places an enormous emphasis on integrity, both in the people he hires and the companies he invests in. But why is integrity so crucial in the world of business and investing? Integrity forms the foundation of trust, and trust is the currency of business. A company or individual lacking integrity might show short-term gains, but in the long run, they're building a house of cards. Buffett understands that without integrity, intelligence and energy can actually be detrimental. They simply allow dishonest people to cause more damage. In your own investments or business dealings, how do you assess the integrity of the companies or individuals you're considering? What red flags might indicate a lack of integrity? Rule number 2, avoid the herd mentality. Buffett has consistently warned against following the crowd in investing. He notes that investors often make decisions based on what others are doing, rather than on fundamental analysis. This behavior leads to market bubbles and crashes. Buffett, instead, advocates for a contrarian approach, being fearful when others are greedy, and greedy when others are fearful. When was the last time you made an investment decision? Was it based on careful analysis of the company's fundamentals, or was it influenced by market hype or fear? How might your investment results change if you adopted a more contrarian approach? Rule number 3, invest within your circle of competence. I have an old-fashioned belief that I should only expect to make money in things that I understand. Buffett's circle of competence concept is crucial to his investment strategy. He only invests in businesses he understands, which allows him to better assess their long-term prospects. For example, Buffett understands the economics of consumer goods companies like Coca-Cola. He can predict with reasonable certainty what their business will look like in 10 or 20 years. On the other hand, he has largely avoided tech stocks, acknowledging that the rapidly changing tech landscape is outside his circle of competence. What industries or types of businesses do you understand well? How could focusing on your areas of expertise improve your investment decisions? Conversely, are there areas where you might be overconfident in your understanding? Rule number 4, focus on long-term value, not short-term price. Buffett is famous for his long-term perspective. He's not interested in making a quick profit. Instead, he looks for businesses with enduring value. Our favorite holding period is forever. This approach allows Buffett to ignore short-term market fluctuations and focus on the underlying value of a business. He looks for companies with strong competitive advantages that can sustain profitability over the long term. Think about your current investments. If you had to hold them for the next 10 years without selling, how confident would you be in their performance? Does this thought experiment change your perspective on any of your holdings? Rule number 5, be fearful when others are greedy, and greedy when others are fearful. This famous Buffett quote encapsulates his contrarian approach to investing. When the market is euphoric and prices are sky high, Buffett becomes cautious. Conversely, when panic sets in and prices plummet, he sees opportunity. Buffett regrets the opportunities he missed more than the investments that didn't work out. He recognizes that the best opportunities often come when others are too scared to act. Think back to times of market turmoil, like the 2008 financial crisis or the 2020 COVID-19 crash. How did you react? Were you able to see the opportunities amidst the fear, or did emotion drive your decisions? Rule number 6, invest in wonderful businesses at fair prices. Early in his career, Buffett focused on finding undervalued, mediocre businesses, what he called cigar butts. However, he later shifted his strategy. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett now looks for high-quality businesses with strong competitive advantages, even if it means paying a fair price rather than a bargain price. He believes that a great business will compound in value over time, far outweighing any initial overpayment. In your own portfolio, do you have any wonderful businesses? What makes them wonderful? Conversely, are you holding on to any mediocre businesses just because they seem cheap? Rule number 7, calculate intrinsic value. Understanding intrinsic value is at the core of Buffett's investment philosophy. He defines it as The number that, if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, intrinsic value is the present value of all future cash flows a business will generate. Buffett aims to buy businesses when their market price is significantly below his calculated intrinsic value, providing a margin of safety. Pick a company you're interested in. Try to estimate its future cash flows and calculate its intrinsic value. How does this compare to its current market price? What assumptions did you have to make in your calculation? Warren Buffett's 7 rules offer a time-tested framework for intelligent investing. They focus on integrity, independent thinking, staying within your expertise, long-term value, contrarian thinking, investing in great businesses, and understanding intrinsic value. While these principles can guide better investment decisions, remember that even Buffett makes mistakes. Success comes from applying Buffett's mindset to your unique situation, not copying his picks. In the words of Buffett himself, the most important investment you can make is in yourself. By studying and applying these principles, you're making an investment in your financial future. How will you put these lessons into practice? Comment below. You may also wish to check out my other video on this book, Transform My Financial Life, in the link above and in the description down below. If you enjoyed this video, do like and share this video so that more people will learn from Warren Buffett's 7 rules. Check out this playlist of my top 10 videos for creating wealth, and I'll see you in the next video. Take care.